As Leslie was just saying, is the runway on net interest income really that long enough to get long some of these names?
So look, at the end of the day, the bank stocks have been the epicenter of recession worries, right? And what they're essentially showing, and I'll get to the NII question in a second, is their resilience, right? And their preparedness for a coming recession. So to answer your question, Carl, I think if you combine loan growth with continued deposit repricing that is lagging the increase in loan pricing, I think you'll get at least another 3 quarters of runway in terms of net interest income growth. Now, that growth will naturally slow if the Fed stops raising rates, as the Fed funds futures implies. But yes, I still see another 3 quarters of pretty decent runway for NII growth for the banks.
Right. You got buys on most of your universe. Citi and USB are the exceptions here on neutral. What are you seeing that leads you to not give them a buy as well?
Yeah, so with Citigroup, look, all of their issues are clearly reflected in their super discounted valuation. But we just think that it's not the time to go long a stock that still is in the throes of regulatory remediation. We think they're behind Wells Fargo, for example, and is considered more liability sensitive than their peers, which means their liabilities price free faster than their assets. Not a great thing in a climbing interest rate environment. And for USB, it's very simple. They're a great company, but we don't really like to be long the stock in its first year of merger integration and conversion.
If I could get back to Bank of America for a moment, I'm just sort of curious to get a little bit deeper into the report. Was there anything that concerned you, or is it overall just sort of how would you grade it?
That was pretty much an A+ quarter. I expected an A- quarter, and I would say that it was an A+ quarter. A couple of things happened, and I really want to, drive this point home. Bank of America increased its net interest income to $13.9 billion, had good loan growth, and outperformed sales and trading expectations while growing capital. It is a very, very hard trifecta to hit, given that banks earn, revenue off of their balance sheet, right? So their ability to grow capital, essentially reduce risk by mitigating their risk-weighted assets and still hitting or outperforming those revenue bands, I think that's really a stellar performance. And like you guys mentioned earlier, they also outperformed in terms of both their expense print in the third quarter and what they're looking for the rest of the year and what they were alluding to for 2023.
How would you, compare it then to J.P. Morgan, as we were doing with Jim Cramer at the top of our first hour? Which would you rather own at this point?
So look, J.P. Morgan is J.P. Morgan, right? They have been for a decade the best in class in terms of revenue generation and really outperforming their peers. I do think it is time for B of A to shine at this point. And I do think that while both banks and both stocks are well positioned in a rising rate environment and certainly well prepared for recession, I do think that B of A will take the mantle from JP Morgan as potentially the sector leader. And I think the simple reason I think that is B of A has to hold less capital than JP Morgan. And therefore, it's easier for them to earn a higher ROE on a comparable basis now versus JP Morgan. Now, that doesn't mean that JP Morgan is not a good stock from here. I just think the rate of change and the perception of B of A is going to change, and they're going to take that mantle as the sector leader.
Hey, finally, Erika, there's been a lot of macro analysis of what we've come to call excess saving, COVID saving, and looking at the runoff. We recently got some revised data, and there's one point of view that argues that sort of rolls off, maybe tires out by the middle of next year. Is it reasonable to expect that by next summer we start to talk about a really troubled consumer base or not?
So there's a difference between a rolling off of excess liquidity and a really troubled consumer base. I think we all heard Jamie Dimon say on the call on Friday for JP Morgan that he expects excess consumer liquidity to mostly drain out by the middle of next year.
Shepard Smith here. Thanks for watching CNBC on YouTube.